Hey traders, welcome to Quantsapp. My name is Varun, and option chain is something that a lot of traders have been asking me to do a video, right? So I have finally given into it, and I will explain what option chain is. So I have done a video about this in Hindi, I guess, but I saw a lot of requests for an English version of that video. So this is that video specifically. Okay. So without wasting any more time, let's just jump into it. So what exactly is option chain? What can you learn from it? Because let's face it, option chain is one of the most important analytics, and it is a free tool inside Quantsapp. So since it is a free tool inside Quantsapp, it is a very good way of knowing where the market is going to go. It has a very good tendency of giving you a very detailed information on just one screen. Okay. So for people who do not know me, my name is Varun. Okay, I am the trainer here. For people who have been watching these videos, your support is immense. I have been loving the support. The comments, I read those comments every day. I look at the reactions that you guys have, the likes and dislikes, right? So keep those coming. That is something that motivates me and helps me improve as well, so that I can bring quality content for you guys. All right. So let us start then with option chain. So I'll just share the screen of option chain. This won't be a very long video. This will be a relatively short video. So I'll open option chain for you guys and I will share the screen. Okay, so this is Quantsapp screen for people who do not know. I am on the web app. Okay, so since I'm on desktop, so I have opened the web app. But if you're on Android or iOS, we have a mobile application on the App Store. So you can just go and install that from the App Store itself. Okay. So yeah, as I said, it's a relatively short video. So let's just jump right into it. I'll open option chain. Okay, option chain is the tool name. You can just search for option chain and you can open it. Let's open Nifty first. Okay, majorly I know people are index traders. So I'll select Nifty. Okay, this is Nifty. We'll select maybe you can select the expiry, right? So expiry can be a weekly expiry or a monthly expiry. Today it was expiry day, so weekly expiry will not help us. So I'll just add the monthly expiry. Okay, so 27 June, as of the time of recording this video, this is the monthly expiry. And you can see this is the option chain. So this is Nifty's option chain. Now you might see that this is not as simple as the other platform. So you can look at NSE's option chain, you can look at any other application providing an option chain. You will always find that this is a little bit more complex, or it has a lot more data points to look at. Right. So I will explain each and every data point, what exactly that does, what exactly it can do, so that you will have an overall better idea of what you can use out of this. Right. Okay. So the first things first, you can search for any symbol right here. Under the expiry section, you can select any expiry that you want. So you can also look at leaps. Let's say if I just want to look at 28 December, right? So you can see these things, right? So you can also check leaps. Normally the leaps that people look at is current year December, right? Or next year December, not more than that. So if I just look at December current year, you can see these are the positions that have been added. Okay. So you can look at leaps as well, but we'll keep it simple till the monthly expiry. You can see the lot size here. So any script you select, you will be able to identify what the lot size is. Okay. Then you can look at the future price. Now this is future price for the monthly expiry. But if you switch it to a weekly expiry, then you will find fair price here. So fair price, for people who do not know, it is synthetic futures. So if you go and check right now, if you pause the video and check it inside TradingView or any other chart, you will see that this price does not match with the spot price or any monthly futures price. That is because it is synthetic futures. So synthetic futures is calculated based on monthly futures, call premium minus put premium. That is the general idea. Okay. So you can think of it this way: since futures does not have a weekly expiry, but options have a weekly expiry, if I want to trade weekly options, I need a weekly futures. So since future options direct underlying is futures, not spot price, so we need to look at the synthetic futures data. So if futures had a weekly expiry, this would be the price. So we use this as an underlying instead of spot price for weekly options to get a much more accurate view of the market, to get a much more accurate at the money option. And the delta values are also quite good based on that, right? So normally when people use spot price and then they calculate delta values, it can go inaccurate sometimes, but we are providing the data in a much more accurate sense with the help of future price and fair price. Okay, so that is it. It's nothing but weekly futures. You can think of it as weekly futures. Okay, all right. There is an option to refresh here, and there is an option for charts. If you click here, it will directly take you to Nifty's futures chart. Okay, all right. In the middle, you will find each and every strike. So all the tradable strikes you will find. The highlighted one here, this is the at the money strike. Above, you will find the lower strikes. Below, you will find the higher strikes. All right. On the left hand side, you will find the data for call options. On the right hand side, you will find the data for put options. Okay. Now I'll explain each and every column. Okay. There is premium. So option premium of each and every strike. All right. So call in the money strike is on the upward side and call OTM is below. Right. Put OTM is above, call and put ITM is below. All right. IB, so implied volatility of each particular option, you can check here. So implied volatility is an option-based concept for people who do not know. Implied volatility is nothing but expected momentum. So option writers are the ones who said this. Option writers are the one who expect a momentum in the market. So that is what you can see. So you can clearly see the at the money options implied volatility. You can see the implied volatility rising as we go OTM, deeper OTM, and as we go deeper ITM. You can see that the implied volatilities are rising there, right? So the non-tradable options, wherever there are no trades happened recently, there you can see implied volatility 0 since there are no trades. But the nearby strikes, you can at least see that it has a change in implied volatility. Implied volatility is different for each particular option, so it can never be the same. So whenever we look at implied volatility, we generally consider the at the money option, but that's not the case because we need different strikes, different implied volatility data to also calculate the skew, right? So I'll explain those things in maybe a future video in English, and we can maybe watch those as well because skew is another one of the interesting concepts of the option data, right? Option analytics. Beside that, you will find volume. So volume data. Volume, for people who do not know, volume is a very interesting data point because volume can give you a bit of insight, and options volume specifically can give you a directional bias as well for people who do not know. Okay. Then just beside that, we have open interest data as well, right? So open interest is available. Open interest data, it will always be available, right? If you look closely, open interest data is something. So open interest data is the most common thing that you will find in every option chain. Every option chain will have open interest data because that is something that all the traders are using. Options open interest, everyone is using. Now let's identify the use case of open interest and volume. So just keep it to yourself. I'll ask one question. Which perspective is used to view options open interest? Right? Do we view options open interest from an option buyer's perspective, or do we view options open interest from an option seller's perspective? From whose perspective do we view open interest data? From whose perspective do we view options open interest data? So if you guess option writers, then you are correct because there is a reason for that. It is because since options has a very non-linear payoff, option writers have a chance that they will suffer undefined losses. So option writers have undefined risk. Option buyers have a defined risk, right? It does not matter if option buyer's view goes wrong. He will always have a finite risk. So due to this reason, we always assume that option writers are creating open interest positions since open interest is nothing but number of open contracts. There's option buyers as well as option sellers, but we choose the perspective of option sellers because option seller will always think twice before creating a new position. So that is the general idea. Okay. So you can see the absolute open interest value, and in the bracket you will see the change in open interest. So change from yesterday. So open interest change from yesterday. So you can see as of now, and on the at the money strike. So 23,600 is the at the money strike. Current open interest is 39,48,300, out of which 20,95,175 open interest has been added today. Right? If there is negative open interest like here, that means open interest has unwinded. If there is positive, that means open interest has added. Okay. Now, unlike open interest, volume is slightly different. Volume can never be negative. Volume just showcases the number of trades that has occurred. So the number of trades that has occurred is defined by volume. Okay. So volume can never be negative. Volume keeps on increasing. Even if people square off their position, volume increases. Even if people create new positions, volume increases. So volume can never decrease. Now, volume gives you a very interesting insight. Let's say if call volume is much higher than put volume, what would that mean? If call volume, let's just look at the OTM strikes. Let's ignore the ITM strikes. Let's look at OTM strikes. So we'll look at the data from here to here. Okay, so from at the money to OTM, these strikes, and then similarly here to here. All right, so upwards you will find put OTM, downwards you will find call OTM. Just look at these volume figures. Okay, if you add these volume figures, where do you think volume is higher? On the call side or on the put side? Just add these values and let me know. You can think of it. Right, so if I look closely, I can clearly see that the volume is much higher on the call side. Volume is much higher on the call side. Even if you consider the in the money strikes as well, if I consider the in the money strikes as well, still I will say that call volume is much higher than put volume. Correct? Call volume is much higher than put volume. Why so? And what does this signify? So this signifies how much square off has happened or how many hedge positions have been created. Right? So let's say if I am a writer, let's say if I am a writer, I am writing the at the money call option. And then I'm expecting the market will go up. What will I do? I will quickly square off and I will try to buy more options on the OTM call side. So that means I have a directional bias on the bullish side. So that is how volume helps you with the directional bias as well. That is the most simplest idea that I can give you out of volume. Okay, so you can identify volume, you can identify open interest, you can identify all of these things. Okay, now a very important part. You might have seen that I have ignored these things, right? These small numbers are there, small text you can see below each analytic. I have ignored this. So I have not ignored this. I just saved it for the last because this is Greeks. Option Greeks are one of the most important things that you will find online as well. I don't think anyone teaches these for free, but you can get a basic idea of what option grades are. I will still give you a basic idea. Okay. So first thing we have is delta. What exactly is delta? Delta is nothing but it is the effect of premium or effect of underlying on option premium. Right? You can think of it this way. If Nifty moves up by 1 point, or if Nifty's future price increases by 1 rupee, what will be the effect of that on an options premium is signified as delta. Okay, so you can see the delta is 0.5 paise on the call side as well as on the put side for the at the money strike. As you go in the money, the delta keeps on increasing. As you go out of the money, the delta keeps on decreasing. Okay, so simplest thing, if Nifty moves up by 1 rupee, then this particular call options premium will increase by 0.5 paise and put option premium will decrease by 0.5 paise. Right? As we go further OTM, you can see This particular options premium will increase by 0.44 paise, and this will be 0.56 paise, right? Or 56 paise or 0.56 rupees. I should have said like this, right? So 56 paise and 44 paise. Please excuse my mistake. Alright. On the in the money side, you can see, let's take this for example. If Nifty moves up by 1 rupee, then this particular options premium will increase by 0.71 rupees. And this put options premium will decrease by 0.29 rupees. That is the general idea of delta. Okay. Then we have theta. Theta again, theta is in terms of rupees. Okay. Theta is nothing but time decay. Okay, so time can never be positive. Time always keeps on decreasing. So theta will show you the exact time decay of that particular day. So let's say if I buy an option, let's say if I buy this particular option, okay, I carry it overnight and everything else remains constant. Everything else remains constant. Tomorrow market opens at the same price. Everything else is constant. Still, my options premium will decrease by 9.85 rupees. Why? Because that is time decay. So option premium has time decay. How much it will decay? Based on this. So it is nothing but change in premium based on change in number of days left to expiry. Right? So as the number of days left to expiry decreases, option premium also decreases. How much? That is the number of theta. Alright? So it is nothing but time decay. Then we have Vega. Okay, Vega is nothing but change in premium with respect to change in implied volatility or IV. So implied volatility always works as a percentage number. So this number is nothing but a percentage number. It is showing you the annualized expected move, right? So let's say if option writers are correct, then the market will move by 10% this year. 10.57% to be precise. Whether it will move above, whether it will move below, does not matter. But the market will move by 10.57% this year. So that is the implied volatility percentage number. This number is subject to change, right? As market keeps on changing, market's momentum keeps on shifting. This number is subject to increase or decrease. Okay, if market's momentum suddenly drops, then this number will drop. If market's momentum rises, then this number will rise. All right. So based on implied volatility, let's say if implied volatility moves from 10.57 to 11.57 for this particular option, what will happen to its premium? So implied volatility, for people who do not know, implied volatility has a positive correlation with the market, or not with the market, but with the options premium. Whenever implied volatility decreases, the premiums will also decrease. Whenever implied volatility increases, option premiums will also increase. It's as simple as that. All right. So let's say if this option's implied volatility goes from 10.57 to 11.57, then this option's premium will increase by 13.04. Okay. If this option's implied volatility decreases by 1%, or if it changes to 9.57%, then this option's premium will decrease by 13.04 rupees. Now, this is considering the rest of the things remain constant, the rest of the factors remain constant. That is considered here. All right. So that is the most simplest idea that you will get. All right. So I hope that is clear till here, right? So this is Vega. Now for the final thing, we have Gamma. All right. Gamma, for people who do not know, Gamma is nothing but change in delta with respect to change in underlying. Everyone knows that as an option goes in the money, if this option goes in the money, then its delta will also increase. If this option goes out of the money, then its delta will also decrease. So how much increase and how much decrease will be there? That is based on gamma. So gamma value, you will find it's very tiny. It's 0.001, 0.004, 0.002. It's something like that. Right? So gamma value is always tiny. So let's say if Nifty moves up by 1 rupees, then this options delta will increase by 0.0012. So it is the impact on delta with respect to change in underlying. So that is the most common idea that people have. So Gamma will show you that. Okay. Now how to analyze option chain. So coming back to that, how to analyze option chain. Generally, since all of us are directional traders, we use it to trade direction of the market, but we can also use the other analytics in terms of other things. Okay. So as of now, I know based on open interest data that the market is supposed to go up. Right? Based on open interest data, I know that the market is supposed to go up. Why? Because there is a very good support on 23,500, which is the heaviest put. All right. If I look at the heaviest call is placed at 24,000. Okay, 24,000 is the heaviest call and 23,000 is the heaviest put. You can see there are some resistances, there are some supports, but majorly the supports are much stronger. 23,500 is a major support. You can see there is a lot more open interest there. And as you already saw, the volumes are much higher on the call side. So you can just compare call OTM. So add the money to OTM and put add the money to OTM. You can compare volume. Wherever there is higher volume, there the market is supposed to move. So here as of now, I know that market is supposed to move up, right? So since market is about to move up, I know that I have to enter a trade on the call buying side. So I can either buy a call option or I can sell a put option. That is the general idea. As of now, I know that we are away from the expiry. Okay, we are away from the expiry. The delta values, I can see that the delta values are not more, distant. A lot of times it happens that at the money delta is 0.5 and OTM delta is directly 0.35 or something like that. So here I can see that at the money delta and OTM delta is not that far off, but the premium has a good change, right? So here I am paying 136 rupees, here I am paying just 130 rupees. So it makes sense if I just go and buy this particular option. Okay, so I'll go and buy an OTM option. So any OTM option I can buy since I'm not losing on delta that much. Delta values, I can see that there is not a big drop of delta the further I go OTM, but there is a good drop of premium. So I can save up some money on the premium while retaining a lot better ROI, right? So that is how I can go for option buying. For option writing, there is a good chance that I could go and write an in the money put option. Same thing. The delta values are not that higher. So in case if my view does go wrong, I am not losing that much money. Okay. Another thing that I could look at is the IVs. So tomorrow morning, if IV has increased, if IV is more than this, then I know that IV is about to increase more. So I can go for an option buying sort of scenario because IV can also benefit me. But if IV is decreased, then I know there is not a lot of momentum. So in that case, then I could go for a selling heavy trade. Right. So that is how you can analyze these things and you can, improve upon trading. So this is always used as technical analysis as well. So technical analysis along with option chain analysis works really well. But I don't do a lot of technical analysis. So good luck with that. So I feel like that is enough, right? That is it for me. So this was the video for option chain for you guys. I hope you guys enjoyed. I hope you guys learned something new. All the best on your trading journey. My name is Varun again. The support has been tremendous. I cannot thank you guys enough. But I will catch you guys very soon in the next video and stay tuned for it. Thank you so much, guys.